purpose today is twofold. Firstly, what I want to try and do this morning is give you some insight and actually recap probably what you already know on where we've got to in terms of the economy, what 2013 was, and the recession that was before 2013. And hopefully that will provide a broad context for the discussions we'll have later this morning in terms of the various trends that Abacus has found and reported in their document on your chairs today. Later on, I'm going to come back. It's a two-session one today. I'm going to come back and I'm going to talk about what the future looks like. Okay? But throughout both presentations, the big question is, from the economic perspective, have we really turned the corner? Are we on a sustainable growth path now, after what has been a phenomenally difficult period? Or, put it another way, can an economist finally actually be positive about the world? It's worth, I know that we're running a little bit behind schedule, but regardless, I think it's worth also providing a little bit of context about economics before we start. And I'm going to do lots of graphs. I can assure you there are more slides here than you can imagine. All right? Please don't assume you've got to read all of them. And I will make sure that Abacus have this after this presentation, will be circulated to you, so don't write things down either. And a lot of them will look, I hope, quite exciting and impressive and convincing. But there's a little story it's worth bearing in mind about economists before you take to heart what I put up here today. There's apparently this character in the US. He went to go and see his brain transplant surgeon. And he said, I've been thinking about it. You know what? I've decided I want to go ahead. I want the transplant. And his surgeon said, okay, yeah, that sounds fine. You've discussed it all. What do you want to do? I could offer you for $10,000 an ounce the brain of an accountant. And the potential patient thinks this sounds quite good. $10,000 an ounce for somebody who's really good at maths. And let's be honest, they're always employed regardless of what else is going on. Yeah, okay, I could be up for that. But you know, if I push the boat out, what else could you do? The surgeon goes, well, for $100,000 an ounce, you can have the brain of an attorney. And they call them attorneys in the US. Anywhere else in the world, lawyers. Yep, but of course in the US, very, very valuable profession. Not only are they good with the language, not only have they got a job regardless, actually they're pretty good business people as well. So yeah, $10,000 an ounce for an accountant, $100,000 an ounce for an attorney. All makes sense. Very interested. But, you know, if I broke the bank, what could you do for me? Well, he says, for $1 million an ounce, you can have the brain of an economist. This bloke goes, wow. He knows very little about my profession. $1 million an ounce for an economist, $100,000 an ounce for an attorney, $10,000 an ounce for an accountant. These economists, this must be amazing people. The consultant, the surgeon, knows a little bit more about my profession than the patient. He shrugs his shoulder and says, you've got to kill a lot of economists to get an ounce of brain. With that in mind, I will go through and do my economist speech. Okay. All right, so the objective this morning is to look at outline recent trends and provide the economic context to this morning's discussions. Just two sections in this part. Firstly, I think it is important to go back and just recap on what the UK economy has been through over the past few years, what the legacy of Lehman Brothers collapse and the global financial crisis has been. Because sometimes it's hard to remember just the scale, or even quantify just the scale of the recession that this country has been through. And then what I want to do is talk a little bit about what happened in 2013. And was 2013 the time when actually the UK economy started to turn the corner? Okay, so the Lehman legacy. You may well remember that front page from the Times back in September 2008. And that was actually not the beginning of the problem. The beginning of the problem was US banks lending lending mortgages on properties to people who could never repay them, and then packaging them in debt instruments where people never realised the risk was there. That was the fundamental problem, but it all came to a head with the collapse of Lehman Brothers in September 2008. Subsequent to that, there was both a financial crisis and there was a real economy impact in that actually incomes, prosperity, wealth, all was impacted by the financial crisis. This is a graph of GDP, gross domestic product, i.e. economic output in the UK, indexed back to 100 for the top of the best it got in 2008 Q1. Since then it fell. That is the shape of the UK economy over the past few years. Just to quantify it, we saw a fall in GDP, a reduction in economic output of over 7% peak to trough in the UK. And today, we are still almost 4% below the levels of GDP that was seen back in the beginning of 2008. A very sizable recession. Let me give you some other sort of ways of being able to think about that. If we had carried on the same path after 2008 as we were before 2008, well, the gap now between where we would have been and where we are is almost 16%. That's how much has been lost from the economy. It's a big recession. Let me just demonstrate in historical terms how big it was and how big actually it still is. That is the Great Depression of the 1930s, its impact on UK output. We saw GDP fall, or the equivalent GDP fall by around about 7%, and it took about 4 years in the 1930s for GDP to recover to the levels it was at before the recession. Those are some examples of other recessions you may have remembered, or you may remember, ones in the 70s and the 80s. This is the 2008 recession, and where we think it is heading thereafter. It is almost, and to be blunt about it, within the statistical era, it's as deep as it was in the 1930s, but we're looking at probably somewhere in the region of 6 years before the UK recovers to its former high in terms of GDP. So a recession that is unprecedented in its length and as deep as the Great Depression of the 1930s, or at least the Great Depression's impact here in the UK. Not only that, it was a very odd recession, significant downturns across the globe, but not everywhere. And actually, a world that was still growing in terms of emerging markets and China, up until this year, in fact, where growth rates have started to fall, although it's still more positive than us, which meant that not only did we have low and falling economic output in the UK, we were stagnating, we also had the risk, and in fact experienced, relatively high rates of inflation as well. Inflation was over 3%, so over the bandwidth that's permitted for the MPC, the Monetary Policy Committee of the Bank of England, was over 3% for 36 months between 2008 and 2012. Inflation and negative growth, decline. Unemployment rose, but unemployment rose far less than people like me expected. We did not get anywhere near the sorts of levels of unemployment, the 3 million number, for example, that was very often bandied around during the Thatcher era. Unemployment rose here, but it did not rise anywhere near as would have been expected given the scale of the recession in the UK, given historical trends. What that meant was falling output, but not falling employment at the same rate, meant that productivity, output per worker, has taken quite a substantial hit through this recession. It's now 17% below its long-term trend. Output per worker, productivity. Now that partly reflects an increase in the share of part-time jobs. So where there has been growth in part-time and flexible working, and there's been decline in full-time permanent posts. But it also reflects a change in the structure of jobs in the UK economy. the job areas, the industries where the bar goes to the right, are industries that have seen an increase in employment through the recession. Where there are bars to the left, those are industries where there has been a decline in employment during the recession. And I don't want to overly stereotype, but averages are averages, I'm afraid. Manufacturing jobs are incredibly high productivity. There's a lot of output per worker in manufacturing. There's actually a lot of output per worker in construction as well. There is much less output per worker in health and social work and in administration and support. What we've seen is we have seen some growth in employment, but we've seen a shift away from higher value, higher productive jobs to lower productive jobs through the period. That has meant that wages have been suppressed. Wages, bonus, salaries, all of them have been suppressed through the recession. However, although wages have been suppressed, as I said before, inflation hasn't been. So what's really exemplified the recessional period since 2008 has been a period of falling real incomes. The growth in wages has been completely overtaken by growth in prices. Therefore, the value of the pound you earn has declined over the time of the recession. That has been pivotal is pivotal in understanding what has happened to the consumer side of the UK economy since 2008. The drop in real earnings, so earnings after taking account of inflation, i.e. buying power of your earnings, that drop cannot be understated in terms of its magnitude. You've got a graph here which, to the best of its ability, given that clearly you can always doubt data that's from over 100 years ago, but it gives you the best guess that economists have about the trends in incomes and inflation back to the late 1800s. And you can see there have been very few instances over that very long time period where you've seen reductions in real earnings for UK households. Not only have we had that since 2008, we've had it at a scale, the drop is greater than we've seen across those periods as well. 2008 is a massive historical, 2008 and beyond has been a massive historical event in terms of the scale of its impact on the UK economy and UK households. Unsurprisingly, in such an environment, you see house prices drop as well, and house prices fell by around about 15% overall on average. Massive distributional differences between different geographies in the UK, but a significant impact on the housing market through the recession, and unsurprisingly, consumers' confidence nosedived. What did that mean for retail? Well, up until 2008 and the recession, retail sales volumes, so in real terms, was rising somewhere in the region of 3.3% per annum on average. Between 2008 and the end of 2012, the 3.3% declined to 0.3% per annum. Of course, that was still positive. If retail sales had followed the path of the economy as a whole, GDP as a whole, the situation would be even worse. There were, though, and I'm not going to go through these in detail, and again, I will make sure that this is available to you all in the next few days, so don't feel that you have to inspect the numbers too carefully just yet. Of course, though, although the average was dismal, there are wide variations in terms of the performance of retail sales by different types of store, different types of channel. And this is just the data from the ONS. There are other sources, and you can argue which one's best, etc., etc. But as you can see here, above average, you saw second-hand goods, for example, clothing stores, footwear and leather, but obviously the real star performer throughout the period was internet-only stores and mail order. The Office for National Statistics doesn't divide the two. I'm sure you'll be able to tell us later a little bit more about where it was though. And there were sectors and types of store that performed less well. In fact, what's the ONS call alcoholic drinks, other beverages and tobacco, i.e. your corner shop, without too much other than booze and fags, saw a real hit over the recession, with the ONS reporting 15% per annum decline in growth, in volumes. So that was the Lehman's legacy, and clearly that meant that when we started 2013, the world was not in a good place. And when we started 2013, it looked like it was getting worse. We had widespread snow in January, and the second coldest March in over a century meant that the first few months of 2013 left many people thinking that we were going to stay in the recession for some time. But things started to change. And I'm not going to pretend you can point to something to explain why it happened either. Probably it was just almost a random occurrence of various things going in the right direction at the right time and it becoming stable. I'm not going to say you can explain what happened in 2013, but we certainly can identify that around about spring in 2013, the economic data started to turn in the right direction. Unemployment fell from 7.9% to 7.2% over the year. Inflation got back on target. The Chinese economy in particular is slowing. It's still growing at rates that we could only imagine, but it has slowed, and that has meant that the demand for energy and the demand for commodities is not as strong as it was in the period up to 2012, which has meant that a lot of the imported inflation that we suffered through the recession has unwound itself, and in fact is now unwinding itself quite substantially. So we're starting to see inflation results now coming in well under 2% on a repeated basis. But we saw inflation back on target in 2013. Yes, real earnings did continue to fall, but the uptick in employment meant that the overall total real wages, so the wages of everyone in employment, because there were more in employment, meant that actually total real wages rose by 1 percentage point over the year. So it's the start of a turn in the labour market and in terms of households' incomes. And all of that provided a little bit of momentum to the property market, over and above the momentum that central London has had from Russians and others buying big houses here. And spring saw a new dawn for retailers. This is again the Office for National Statistics, Office for National Statistics retail sales statistics on a monthly basis. Overall, 2013 sales were 2.1% up on 2012 in volume terms, and that was against only 1.4% in 2012 versus 2011. But most importantly is when you look at the rate of growth in the second half of the year, after a little bit of the turn, actually the recent growth through 2013 was more like an equivalent of 8.6% annualised growth in retail sales. I'm not saying you're going to see that continued for that far, but actually it gives you an idea of the scale of uptick that you got through the year. A flat beginning, but then something that grew very, very quickly. Again, that varied dramatically between different types of store. Floor coverings, carpets, all the rest of them, apparently, according to the ONS, was the one that saw the greatest May to December growth at an annualised rate of 34%. Again, I'm certainly not going down to Ladbrokes and betting that's going to happen a second time, but it gives you an idea of the strength of the uptick in the second part of 2013. Equally, there were a number of sectors that performed below average in that context as well. And equally interestingly, we started to see some tentative signs in 2013 through the M&S data of an ability for retailers to start to think about pushing prices up. Up until 2013, only really the food stores, the supermarkets, had been able to pass through anything significant in terms of price rises to consumers. Up to then, non-food stores were seeing very, very small, if not negative, price improvements. Some evidence that towards the tail end of 2013, non-food stores started to buck that trend, and greater evidence that non-store retail substantially bucked that trend tail end of 2013. So growth in volumes and the start of a signal of growth in prices as well. And of course, underpinning all of that is an absolutely monumental swing across different categories towards non-retail and internet shopping. Right. That, for me, is the context for what 2013 was. A substantial, as I say, a historically significant recession after the Lehman Brothers collapse. And then in 2013, for some reason which somebody at some point in time will write a great thesis on, but who knows yet why, but sometime in 2013, things started to change. And we left 2013 with retail sales up, with the economy starting to grow again, and with actually the prospects for growth in prices in across the retail sector as well. That's where I'm going to leave it now. I will come back later and talk about what 2014 holds in store. Thank you.